Good afternoon, financial professionals. I'm Dan Peterson, President, Managing Partner here at E4 Insurance Services, and we're welcoming you to The Brew, where we build relationships every week. Thanks for tuning in to today. And for those of you joining The Brew for the first time, welcome. We like to start the Brewcast by celebrating what is our national day. And today, Wednesday, the 10th of January of 2024 is National Oysters Rockefeller Day. So that delicious treat, if you're into that, with the crunchy goodness. It's also National Houseplant Appreciation Day. And one that my parents always made me keenly aware of is National Cut Your Energy Cost Day. I'm sure many of you have had the daily struggle of kids not turning off the lights, and the classic "don't touch the thermostat" conversations, but that is the national day today, so cut your energy costs. We're thrilled today on The Brew to welcome Tiffany Markarian to The Brew once again. Tiffany is Managing Director and founder of Advantus Marketing. She is an award-winning marketing strategist, a keynote speaker. She spoke at a number of our meetings, an elite coach to financial advisors, and I'm happy to say she's helped coach our organization. And she was named Top Marketing Strategist in 2023 by Financial Services Review magazine. So Tiffany, welcome.
Thank you so much. What a great opportunity to be here again with all of you. Happy New Year.
Happy New Year to you. Tiffany, as you know, we're undergoing an initiative this year to bring 12 different themes throughout the year, in addition to the basic blocking and tackling and financial advising and insurance and all the things that we do every day, but really a focused planning ideas around the area of business ownership and business owners. So this month's theme is business valuation. It begins with the value of your business, and then what do you do with that value? How do you protect that value? How do you liquidate that value? How do you buy-sell plan off of that value? And next month, we're going to get into the buy-sell planning piece of that. But that it starts with the valuation. And one of the areas you really focus on is helping financial advisors and firms, whether that's fee-based, fee-only, insurance-based planning, as helping them increase the value of their business. So we're going to take that step with you today and talk a little bit more about the advisor as a business owner and how they improve the value overall of their practice. Does that sound like something we could cover?
That's brilliant, because there's a lot of misnomers out there and perceptions that, if not addressed the right way, could cause some detriment to the advisor, meaning missed opportunities.
Well, there's a lot of advisors that are changing. They're in motion right now. They're moving from FINRA and that to RIA, where there's just a lot of things going on. We have best interest standards. We have the fiduciary rule now coming down from the DOL again. But I've heard it said that advisors should start early as they think about their succession planning. And you've often mentioned 5 to 7 years, which seems like a fairly long time. What is the magic with a specific time frame?
Yes, 5 to 7 years, that's actually the minimum, Dan, that we recommend, because when you just said increasing the equity value of your business, what if there's some adjustments in the business or initiatives that have to be taken on to improve the value of the business? The longer that you wait to do that, to either find a successor or begin the valuation of your business or identify what should be adjusted in the business, the longer we wait, we could be at the risk of an emergency crisis that happens in our lives, particularly if there's a premature death, hopefully not, an illness, a challenging divorce, or any type of crisis. So in the case of, again, an unforeseen disability, illness, death, it would be a bumpy process, one for your clients who we care deeply about and have long-term relationships, but everyone involved to try to pull this together quickly. So with enough time, one, you can build a short-term plan, right, to improve the valuation, the long-term plan for you to come to terms with the right exit for yourself, work on tightening the business. So things that can detract from the value of the business is how you're structuring revenues. Do you have enough tech in the business so that if someone were to take over the business, they can easily access notes, profiles, what's going on in terms of future business for that client, ages, so forth, portfolio values. You do that, now you can have an end date to work from, which gives you more relief and control.
This topic for financial advisors and firms, is it always tied succession planning to buying and selling a practice?
No, because there are some advisors that they might have a particular business model, or they might work for a firm where you don't own that business, and that perhaps your exit strategy might be vested types of compensation, etc. So it's not always tied to buying and selling, but when done early, we may want to focus on the lifestyle that we want to have. So you might want to scale back your working hours. Maybe this business, let's just tell the truth, with all of the regulatory environments going on, it's harder to manage, right? And stay in compliance and peace of mind, making sure that we're documenting in regulatory environments. But maybe you want to work with a limited number of clients. So you might transition maybe the lower tiers of your practice and maybe just work with your top 10. Or you might want to transition, say, the health insurance lines of your practice as an example. So if you have a business model that allows for the sale of your practice, you could strategically transition the equity over time to other partners gradually. And that's a way to reward key employees, right? Keep them motivated to stay if any of them are tapped to be your successor. And when you talk about RIA models and the independent community, a lot of that is salaried employees. And it's not till you get to the senior levels of leadership that your real track is equity. So you want to be able to retain those people. So you might transition equity to other people while you're still full-time. So this is about, do we want to have the benefit of staying on in the practice on a more limited scale? And maybe over time, our strategy is work 4 days a week, 3 days a week, 2 days a week, depending upon your desire to stay involved and manage.
So many times the business has been built by a founder or someone that was a visionary that took the risk and built the relationships with all of these clients and the people that they work with, and you have this dynamic of somebody new coming in. With your experience, how can advisors be certain that clients will stay with the new successor or be well taken care of in both ways? That the clients that I've invested my life in supporting and helping grow their wealth will be taken care of by the next firm.
Well, you can't be certain, right? But you can certainly influence the process. And this all comes down to something that's called transition risk. This is a big part of valuation as well. They're actually going to value as part of the process, not just what you could earn, but for the buyer or successor, what's the transition risk that those clients won't stay? And why I say you can't be certain is, remember, the clients are under no obligation to work with your successor, especially if there's a big disconnect in the way that that successor eventually wants to conduct business or their planned future service models that might be different from what the client is used to. So this is, again, why it's recommended to start 5 to 7 years early, right? So that you can find a successor. And if they're going to offer more opportunities to the clients that maybe they haven't been exposed to, it can be done on a planned and gradual basis. So your clients could be introduced to a successor over a period of years, which allows them to deepen relationships, bond with your staff, and increase the likelihood that that business will continue. Because remember, in many cases, your clients might even have deeper relationships with your administrative staff than anybody else on your team. And most buyers of a business are a bigger entity. So is your staff even going to stay on board? And if they don't stay as part of the process, any disruption in a service that the client is used to can cause anxiety, uncertainty. If there's no solid relationships, then that client might say, well, I've always been loyal to Dan and Brendan, but now I want to work with this person at my bank because I really don't know the successor. So that all increases transition risk. But here's another example. Let's say, as the advisor, your wealth management services have historically been insurance planning, annuities, or mutual funds, and your successor really sees the value in your practice and they want to transition right away to a fee-based practice because that's their model. That may be too drastic for some of the clients, and that's obviously going to increase transition risk. Transition is basically the clients aren't staying, the revenue that we bought is now starting to dwindle away. And by the same token, though, if the successor is introduced to your practice early as part of this gradual succession plan, again, they get the time to build relationships, be exposed to new services and approaches that could be beneficial. But here's one more thing, that if your practice has proprietary products and services that are different or not available on your chosen successor's platform, or they're too difficult to transfer, no selling agreements in place, if the client has to repaper their entire portfolio just to do business with someone who's unknown and came in the last 6 months, hence some retention or transition risk.
So you've mentioned a number of things that can create that transition risk: staff, structure of the business being different, not a
Lack
good
of relationships.
lack
Yep.
of relationship, not a good handoff to the
Disconnect in services that they're not used to, fees that they're not used to paying.
And firms that do this, that are acquiring or could be a part of that solution, you said they quantify that transition risk somehow. How do they do that?
A good valuation company. If you just say, I'm going to go to my bank, how much is the recurring revenue? What do I have to pay for, a year or two of that? Then you're basically valuing that in black and white, not looking at the nuances within this practice. And if, for those who are listening that might be tuning in because they want to take over somebody's practice, the due diligence is up to you, because that seller of the practice or that owner of the practice you want to join might say, well, here's my client base, here's the ages, here's the revenue. What if that owner of the business has been a very transactional nature with their clients and they haven't talked to some of their clients in years? Do you really know what you're purchasing?
Okay. So that's why 5 to 7 years is a minimum, because in your view as well, you're coaching, consulting, and there's time then to address these transition risks in your practice and how you go about positioning yourself for a successful transition. I got it. How can advisors maximize the value of what they've built, especially in the area of the succession process?
Right. So what you just mentioned, the valuation is a key part. So to put this in perspective, if you look at a medical practice, they have physical plant, equipment, inventory, a patient base, and that can be easily valued. But financial practices, like we've just talked about, have way more complexities. So if your practice is weighing heavily on ongoing recurring revenue and deep relationships and future business potential, that may very well have a higher valuation. But how you earn revenue may affect how that practice is worth. Or also, what if your clientele is much older, well into their elder years, still viable, of course, but they're living off the assets that they have invested with you. And maybe you have no proven next gen relationships with those families. Now we have diminishing portfolios that could affect evaluation. And I know, Brendan and Dan, you're very familiar with this, but the insurance community is often used to EBITDA as an example in valuation. And advisors who are more used to fees or AUM or the profile and potential of the clientele in their book of business, that's really where the valuations lie, because it's about, is that revenue going to continue and what's the likelihood of transition risk? So today, I also want to make this note that even if you are an advisor that's mostly AUM or fee-based financial planning, if you incorporate insurance planning in your book, I just want you to know that the good valuation companies specifically focused on financial services, FP Transitions happens to be one of them, incorporating insurance lines means that there's a significant amount of emotional level and protection to keep that client within that book. It can boost evaluation by 10 to 15%. So in short, you might have in your head, I can get 2 to 5 times recurring revenue. That's what the street market is out there. Well, a lot of times that's the bigger deals that are private equity financed. If your practice is behind the 8 ball, meaning still a lot of paper files, we haven't really incorporated CRM technology like we should, automated workflows. If a successor is going to have to dig just to do a communication with your clients that they've taken over, you may not have as high of a valuation. It's a buyer's market today, so don't get me wrong. So the proper valuation, if your business model, if your broker dealer allows it, the good ones have mastered this over 25 years. So once you have a valuation, if you don't like that number, those 5 to 7 years gives you time to make some of the adjustments and changes so you can really maximize it. And finally, Dan and Brendan, do you actually own 100% of your business? So let's say you've got several hundred clients in your book, but a lot of it early on was joint work, or in the wirehouse model, it's tied up in split codes. And in the wirehouse model, you don't really own that clientele, or you're in an RIA where you're a partner, but you don't really own the relationships. You'd have to buy them out. Finding a successor outside of that firm is going to be difficult.
You mentioned the multiples and what you're seeing there. Now, interest rates spiked last year. The cost of money and private equity got a little shock to the system. Are you seeing that in the clients that you're working with that have been preparing for a transition? What are you seeing there?
Okay, so these private equity relationships, those are the ones that get the press, right? These are the ones that are like the billion-dollar firms, the creative planning, really significant firms of the world. And with those interest rates, the private equity has slowed down, but in no way has the smaller solo practices slowed down. The ones where there may be some funding within broker dealers, or there may be just smaller funding of, say, an advisor that has 20 million AUM, right? 30 million AUM, 100. Those smaller deals, those don't get in the press because they're not private equity. They're funded by another, not smaller, but just not the billion-dollar firms. Those have not slowed down at all because advisors are aging.
Okay, good. Yep, good to know that. As we wrap up here in the time that we have left, what are the other aspects that can derail a succession strategy that you see, Tiffany?
Yes. First one, legal and compliance. So we all need to make sure that whatever's been agreed to isn't just a handshake or verbal commands and post-it notes, right? We need to have the necessary legal agreements and documents in place. And we also have to work within the regulatory requirements and privacy laws and so forth. So you want everything in writing, notarize, protect clauses for each other. As an example, everyone should know that there's been press out this year that for the succession plans and buying, selling of practices, 50% of advisors weren't quite happy after the fact. That's a big number. And if I'm the buyer and you decide to check in with the clients, hey, how's it going? Oh, well, I'm sorry. Can I still work with you? There needs to be protective clauses that, once we exit, we're not stepping into the business, and vice versa, right? Another one is, what if we communicate the successor too early? And that might sound like complete contradictory to everything that we're talking about. But I wouldn't suggest doing a big PR splash the day after you decide on your successor. Because what if it doesn't work out? And so you might mutually agree to position the successor first as a significant senior member of the advisory team. Then, as they're introduced to clients and begin to be accepted, and you know it's going to work, then you start announcing that person as the successor. That may be hard for the successor to swallow, but it's actually the right move, because we don't want to spook clients. Oh,
Right.
well, what's happening with my advisor, right? Or it could be a disaster if it doesn't work out, because everything's great until we put things into action, and then we have to start doing these things. Oh, wait, I'm releasing control. Well, these clients have always been used to me. Do I want to bring you into the meeting? If it doesn't work, and then you have to communicate another successor 2 years later, not really a good look, right? And then finally, this is probably one of the bigger ones behind legal and doing it the right way, is the emotional preparedness of the advisor. And you deal with this with your business owners too. Succession planning, it's emotional stuff. No matter how tough and how stubborn we might be, letting go of a practice that we've built over the years, difficult. You might have strong attachments, anxiety about the whole process, uncertainty about what you're going to do in your post-retirement life. Your practice is often your professional identity. It's tied to your personal identity in some cases. So this unresolved emotional stuff is why people procrastinate and don't do the minimum of 5 to 7 years. And that could be to your detriment and your overall success. Here's the biggest issue that I see with succession planning, and this comes down to the successor. When you keep changing the sunset date after you've agreed to have them come on, your successor's probably going to bail because they came on with a date. A lot of successors are going to make great changes in your practice, and revenues start coming up, and you as the owner might be like, this is fun again. That's not fair to the successor, and we don't want to lose that person. So here's some questions, and you might even want to translate this into questions you ask your own clients, is when will I be ready, if I really think about this, to step aside from my practice emotionally and financially? Do I want to retire and sell the business, or incorporate that successor right now, maybe move to more of a lifestyle and keep working with my favorite clients? Who's going to help me with the financing? Hence, we need evaluation, the due diligence of successors, the regulatory and legal and tax aspects of a transition, right? Is that going to bump us into an estate planning situation when 2025 comes? How would I want to receive a payout? Because a lot of these aren't just cash deals. They are in the smaller arrangements, but is there an earn out where they want you to stay on for a few years? And is my retirement dependent upon me selling this practice? And what if I'm not able to sell it? So what am I going to do at that point? So hence, Dan, where we started in the beginning, give yourself time to prepare for, plan, so that you can really have relief, control, and maximize this whole process at every phase. And you know who will benefit? All parties, most importantly, the client.
Well, that's great, Tiffany. I've jotted down here, it's not just an accounting number. This
No.
isn't just looking at multiples of earnings. There's lifestyle consideration. There's the timing of the transaction and the transition. There's the transition risk mitigation that you assist with. There's the financing of this. There's the legal, regulatory, and compliance challenges that you have with this. And lastly, how you want to structure the earnout. And all of that takes time in order to make sure it's done right and you maximize value.
It does, because years ago, a lot of advisors like, well, I'll go to the bank and get fine. And the bank's like, what's actually backing this? It's client relationships who aren't under any obligation to stay, and asset values go up and down with the market. So it was very hard years ago for banks to even consider that. Now where there's more valuations and more opportunities for private equity, broker-dealer funding in many cases, there's options, but we need to really see them clearly.
Well, very, very good. Let's open it up. If there is any questions, do we have any questions in the chat? I don't see any at this point, but we can open it up. Otherwise, we do have a drawing every week for a Starbucks gift card and also some CE vouchers. Who's the winner this week? Tiffany will need to draw a number between 1 and 20.
16.
16. Carol, congratulations. We will be in touch with you. Danielle will be reaching out to you. So thank you for being on the Brew. Any last minute thoughts, Tiffany? You're looking forward to 2024, and what do you think will be the theme of this year for the financial services industry?
Scale and efficiency. You
Scale.
mentioned scale and efficiency, and what I mean by that is it's getting harder to compete at a high level with service, exceptional service, right? There are a lot of individuals moving to recurring revenue models, which requires you to give value to clients who are paying you directly. Mean more time spent with them, deeper value, so we don't lose that business and have them go somewhere else, and having to make sure that we're profitable because we give a lot of service to those clients, but are we pricing it the right way? And so scale, easily repeatable workflows, having niche markets as part of the practice so we can have an efficient way and not having a vanilla approach or trying to restate our value where we can become well known in markets. That scale and that efficiency to be able to run profitably and not cost us too much in time in trying to service this business is key.
Absolutely. Well, very good to be with you again. It's exciting to hear again the opportunities that are coming your way and the ability for you to continue to make a difference with financial advisors and our firm and all the firms that you work with that are part of the Libra organization as well. So
it goes both ways. Toot your horn, big awards, fastest growing firm in networks. And that's not because you're all growing, it's because you're giving value to advisors and they're coming along with you. So congratulations to all of you.
Well, thank you.
ID 20.
Appreciate that very much. Well, that wraps up our brew for this week. Next week, join E4 with Kelsey Lane from Grail Insurance. Kelsey's going to share how leading life insurance companies are embracing innovation to detect cancer early with the new test Gallery. I know Brendan and I took this test at the Libra Fall meeting, and it's the first of its kind multi-cancer early detection test that looks for a signal shared by 50 plus types of cancer with a single blood test. And a number of our insurance companies are going to be bringing this out to their customers as an opportunity. So it's exciting new technology that actually insurance companies, life insurance companies are embracing, and you're going to start to see this as an offering for policyholders. So we'll be talking more about that and bringing that awareness to our advisors on next week on The Brew. So thank you. Well, Tiffany, that wraps us up. You have a great start to the year. Thank you for joining us. Greetings to this beautiful snow you have in New Hampshire, and we hope that it looks like a Christmas card out there. So enjoy.
Thank you, and to everyone who tuned in and will tune in to the recording. Happy New Year! Best wishes to you all.
Very good. Well, thank you. Bye now.